A tax targeting grandmas, a tax robbing your kids of their inheritance, a tax that will force hard-working Aussies to sell their farms. With headlines like this, the proposed change to superannuation tax must be a massive, disastrous deal, right? Well, not really. Here's what's actually going on. So in Australia, we keep our retirement money stored in super funds, which invest that money and help it grow over time. Now, the amount you earn from that investment each year is taxed, but at a way discounted rate compared to most income tax, just 15%. And this discount overwhelmingly benefits wealthy people. In fact, the richest 10% of Australians get more than $20 billion a year in tax breaks from it. And that's despite these people already having much, much more in their super than they need to comfortably retire and avoid being reliant on a government pension, which, you know, is the whole point of that discounted tax rate in the first place. The change the Albanese government is proposing basically draws a line at $3 million in your super. Everything below that line stays the same, but the proportion of your earnings you make from the amount of your super that's over $3 million will have an extra 15% tax added on top of the regular one, so 30% in total. For context though, $3 million is 8 times more than the average person has in their super when they retire. Currently, this change would only affect about 80,000 Australians. And according to Guardian Australia analysis, if you do retire today with exactly $3 million in your super, you'd have to pay a whopping $2,355 extra in tax. So basically, don't worry, your plans to summer on the Amalfi Coast are safe. So why is this controversial then? Well, one of the main two things the media's been freaking out about is that unlike the regular super tax, this new one will also apply to something called unrealized gains. To explain what those are, let's say that one of the investments in your super is a farm you run, and one year that farm increases in value by a couple of $100,000. You haven't actually sold the farm though, so that profit you've made is kind of just theoretical. It's a gain, but it's an unrealized gain. So with this change, you'd have to find the cash now to pay tax on profits that you might not actually see for years or even decades. And what if somehow, despite being among the richest Australians, you don't have the liquid cash on you to pay that? Well, that would be a disaster. An extremely specific and unlikely disaster, but a disaster nonetheless. However, Harry Chamay, who's a superannuation and wealth management consultant, told Guardian Australia that most super funds have very limited exposure to this risk associated with taxing unrealised gains, and that really it's Australians with self-managed super funds that would be most likely to be affected. Self-managed funds are more common among the wealthy, those who might be affected by this tax, but still, of the around 20-ish million super funds in Australia, about 1 million are self-managed. And only 15% of that million belong to people under the age of 45, which brings us to the other major line of attack, that this tax may well just be hitting rich old Australians now, but won't somebody think of the children? And by that I mean the young Australians in the future. Most young people working today will never reach 3 million in their super. Treasury modelling suggests that maybe 1 in 10 people will get there by 2050. But the thing that's important to understand is that the government isn't currently planning to raise this $3 million threshold in line with inflation. So slowly, this will begin affecting more and more people. Diana Musina, the Deputy Chief Economist at AMP, has calculated that without indexation, a 22-year-old today earning average wages for the rest of their life will breach the $3 million mark by the time they retire. Pretty terrifying. Although, to be clear, most experts reckon that the idea the threshold won't just eventually be raised is pretty ridiculous. But what Messina is saying is that a plan for those increases could just be included as part of the new laws rather than hoping and assuming they'll happen. Okay, so at the end of the day, is this super tax change a super big deal? Well, unless the law does remain unchanged for the next 40 years, or you just so happen to be a super wealthy person who somehow has next to no liquid cash in your bank account to be able to pay a few extra $1,000 in tax, then nah, I wouldn't worry about it. Although, if you are one of those 80,000 people that will be affected, can I remind you that The Guardian is always open to new supporters.